Hello, and welcome to C-Suite Secrets. I'm Heather Parsons, your host, a serial entrepreneur, fractional CFO, and a business strategist. I've spent years juggling business and family life while helping entrepreneurs scale, optimize cash flow, and build real financial success. On our show, we bring you real conversations with founders, executives, and operators who are actually moving the needle in their business. No fluff, no filler, just smart systems, strategies that work, and insights that you can put to use in your business right away. Right here is where we usually dive right into the episode, but today is going to be a first. If you've been listening to C-Suite Secrets, you know that we spend a lot of time talking about how real decisions get made at the highest level of business. The conversations that happen in the boardroom, not just the highlight reels. What you may not know is over the last year, I've been working on something quietly, and I haven't been doing it alone. In my work at Summit CFO, I keep seeing the same patterns. Founders who are profitable, growing, working hard, but still super reactive. They're making big decisions without true financial clarity or a capital strategy in place. At the same time, somebody else who is sitting on the other side of the boardroom is seeing the exact same issues, just from a different seat. Joining me today is Jen West, founder of Wild Fig Commercial Lending. She's not just a guest, but she's also my business partner. Jen works with founders at the exact same moment when capital is on the line, when clarity, credibility, and risk management matter the most. And together, we realized something important. Founders rarely get access to both of our perspectives early enough. They don't have a CFO sitting in their boardroom or a lender. So today, for the first time, we're announcing OneRoom, which is the financially minded CEO approach. It's a joint venture that we built together to help business owners step into real financial leadership and long-term freedom. Inside our OneRoom community, or our boardroom as we call it, founders learn how financially minded CEOs actually think, how they evaluate risk, deploy capital through both the CFO lens and the lens of a lender. Today's conversation is a real look inside the boardroom and what it truly takes to move the operator to CEO. Jen, welcome to the show.
Thank you. I'm so excited to join you today, and I'm so excited that we're launching this course.
Me too. I can't wait. I think this is going to be really good for our listeners and really good for people who are trying to grow in their business or don't really know why they're feeling stuck. So,
Exactly.
for our listeners, if they haven't met you yet, tell us a little bit about yourself and how Wild Fig Commercial Lending came about.
So I have more than a decade of experience in the finance industry. I think that I need to look back at the official date because I think we're creeping up on maybe like closer to 14 years. And that experience is in a really wide range of different industries. So I was in banking, I was in mortgage, I was in business lending. And one of the things that I recognized is there were many times small tweaks that business owners, CEOs could implement early on to make things run smoothly. And that's how I ended up building and opening Wild Fig Commercial Lending. I wanted to be able to advise clients on an in depth lending strategy and not be limited to one bank, one debt fund's particular goals. We really wanted to be able to look at their long term goals. And then we typically look at options between hundreds, sometimes thousands of lenders just to see who's going to be the best fit.
I love that, and I think that's what a lot of our founders need. They don't need people or banks to shoehorn them into something that doesn't fit. They need to be met where they are.
Exactly.
So, as you're working with these entrepreneurs, what's the biggest misconception that founders have when they think that they're ready to bring in capital?
A lot of times they're waiting until they need it to get it set up. And I think they're also looking at just one financial institution's products. So a lot of times they've met with somebody and they say, these are the steps that you need to take. And they set out on a path to do that. And one of the things that we have to keep in mind is there's a lot of different ways to access capital, and not checking in regularly with the person that's helping you is really a huge mistake. So if you talk to Sally at XYZ Bank and she gives you steps that you need to follow, and you spend 6 months to 2 years doing that, we don't know what changes have happened in that time. So I think really having a partner that's doing regular check ins can be really helpful. And then just making sure that you're not just looking at one solution.
I think that's some great advice. One of the
Hmm.
things that I do to help out with that, I made one of those calls today to a lender who holds one of our mortgages for our apartment complex just to check in, and it doesn't have to be anything super formal. He was driving to lunch. I just gave him a call. Hey, hadn't talked to you in about 6 months, wanted to check in, see how things are going in the market. What are you seeing in the area? And it's a great source for information and advice as well because they are, while you may only need one loan, they're doing it every day. So they
Hmm.
know what's hot in the market, they know what they're lending on, and it gives you an opportunity to learn a little bit more. It's not just a transaction, it's really a long term relationship.
Exactly.
So, as these founders are coming to you looking to have a conversation about lending, what actually happens behind the scenes if they walk in and they're not prepared?
That's a great question. We typically try to prevent this from happening, but it's not unusual that somebody goes to a lender and maybe says some things that they shouldn't. And then it has the lender wondering, is the borrower being proactive or reactive? And after this happens, they're typically wondering, how difficult of a transaction is this going to be? So, for example, I had a client who was looking at buying a large development, and he really had several different ways that he could continue to develop this. They made the mistake of telling the lender all of their future construction plans, and this particular lender is looking for assets that are currently performing. They don't want to be looking at projections. And it really just clouded the, I think, the visibility of the current project, and made them think that this wasn't going to be cash flowing as is. And essentially that particular lender just decided to step away. Um, a lot of times once we say something that we shouldn't, we can't take that back, if that makes sense.
That makes total sense to me. And I think this is where a lot of founders get stuck because
Hmm.
nobody explains the lender side or the CFO side of things early on. So when you evaluate a business, what are you looking for that most founders don't realize they're being evaluated for?
So it's gonna be coming down to several different things. How are we making decisions? How is money being managed? How predictable does the operation feel? Are they building, or are they constantly reacting? And then, is the leverage that they're looking for going to increase stability or stress? Lenders don't like to fund ideas, they fund behavior, if that makes sense.
That makes total sense to me, and that behavior and building those key foundational parts of their business is a lot of what we're trying to do in OneRoom. When Jen and I decided to officially partner up and build OneRoom, we did it the exact same way that we evaluate businesses in real life. Phase one of our boardroom is really all about financial clarity and fundability. We're trying to get to the truth of the matter, what's going on from both sides of the table, so that we know where we're starting from. And once we have that information in place, we move into phase two, which is really all about financial control and building that credibility that Jen's talking about around, the discipline, the predictability that really builds trust. And once we have our base set, we have our numbers, we know what they are realistically, and we have that credibility and trust moving in the right direction, then we move into phase three, which is learning how financially minded CEOs really take time to grow. This is about capital strategy and scalability, putting structure in place and protecting long term value. It's not a course. This is really a framework and a way to get entrepreneurs to think like a CEO and like they have members of their boardroom, which is like Jen and I, who are there to assist and help them along the way. So when I think about that, and the financial clarity piece and fundability, Before a business ever thinks about growth, what else should they think of from your perspective?
I think what you have to keep in mind is growth is going to magnify whatever foundation that the business was built on. So it can create momentum or it can create chaos. If they're messy, fragile, that growth is just going to create pressure. And capital isn't going to fix your foundation. It's just going to cause weight on it. One of the things that I see founders do fairly often when they're seeking funding is they go to the lender, they tell the story, and the story that they're telling is honestly it's not intentionally untrue. It's just it's worded poorly or they may not have a correct understanding. You and I are working with a client who essentially hadn't been tracking income correctly in the past. And this in no way was anything that deceptive. They were just managing their own books. They were doing their own returns. They didn't know any better. And so the way that they were accounting for over a $500,000 in cash when they originally talked to us sounded it sounded really sketchy. I mean, there's no
Yep.
other way to say that. It sounded really sketchy. We really got to the bottom of where this money came from, and then we were able to tell the story before we approached any lenders. Because I would say the majority of people we work with are never going to purposefully try to do something deceptive. They just don't realize the optics of what may be happening in the way that they tell a story.
Absolutely. And in all fairness to founders and other people who may not have, you know, a master's degree in accounting and 14 years in lending, you don't know what you don't know. And you can't teach
Mhm.
yourself things you don't know. You can watch YouTube videos, but there's always a piece or two that's missing. And you said something that I really want to hit on. If you're building on top of a system or a foundation that's cracked, all you're going to do is break that system. So, whenever I think about those pieces and parts, I know cash flow is the first thing that comes to mind for me. But
Mhm.
whenever you see a system like that that's broken, what's usually the first thing that comes to mind for you?
When I see a system that's broken, obviously we want to start to create clarity. There's a lot of small things that can make a huge impact on cash flow. I would say one of the things that should just be done from day one is make sure that you are separating your personal and business expenses.
Oh,
Just because
yes,
we want to,
please.
yes, we want clarity in terms of what is actual income versus Aunt Sally's, Christmas gift to you each year. So separating income is going to be a huge factor. I would say one of the biggest things when a system is broken is going to be mindset, though. If a founder sees financing as a rescue and they're reacting rather than being proactive, it's going to continue to magnify those issues. And this is going to lead to cash flow strain. And that's the last thing that we want happening. So, we typically, when we're looking at broken systems, we're trying to address mindset, structure, and then cash flow because clarity is really going to be a prerequisite for gaining capital.
Absolutely. And I love that. And talking about that mindset piece of thing, you know, whenever I work with a founder, a lot of times I see that they're using funding as a way to kick the can down the street. They
Hmm.
know that they're feeling the pinch. They know that they're struggling with payroll. They haven't paid their self in a little while, and they think that that injection of capital is going to be their saving grace. It can be for a little while, but it really just kicks the can down the road and it prolongs the inevitable. So without actually fixing those things, it's not really gonna help. It's just a short-term injection, and you're not really getting to the root cause.
Hmm.
So, from your seat, what's the real cost of founders making decisions without, you know, knowing their numbers, and how do lenders interpret that risk?
So the real cost isn't just going to be a decline, it's going to be lost leverage, lost time, lost options. When founders don't understand how lenders view risk, they're going to be making decisions that could feel smart operationally, but look risky financially. So, those things, again, like commingling funds, waiting to document income, structuring deals for speed instead of stability, are always going to be some of those mistakes that we see happening. One of the things that I always try to mention just as a tip is when you're looking at capital, a lot of times the quicker it is, the worse the terms are. So I always like to bring up merchant cash advances. You and I have talked about this.
Oh,
It
yeah.
is so easy to get funding, but it's typically going to come at the cost of 2 to 300% interest rates because they're evaluating the income that you have coming in daily, and then your repayment plan is going to be based on a percentage of that income, which means it's also going to be looking at your growth. So if the repayment plan is 10% of 5,000 this week and your income increases to 10,000 in a few months, they're still taking 10% of that total income. If that makes sense.
It makes sense and it's terrifying, right?
Mhm.
So anytime I work with a client and they bring these options up, they should be really and truly a last resort. We
Yeah.
should be looking at so many other things before we get to that point, and I know we talk about this a lot, but most founders really think that capital solves all their problems. So
Mhm.
whenever we're thinking about these merchant cash advances, and other options that are actually on the table. Talk to me a little bit about why timing and structure matters a lot more than access to this capital.
So timing and structure matters because we can start developing a plan that's going to be looking in the future, 5 to 10 years. So a lot of times we see founders make the mistake that they work really hard, they start having revenue coming in, and they've maybe not made plans for the type of capital that they're going to be needing. And so we're seeing frequent declines. We're seeing maybe advice being given to do XYZ and come back in 1 to 2 years when we could have gone ahead and planned for whatever that contingency, whatever that capital need was far in advance. So we are essentially planning for needing capital from day one. A lot of times we see clients come to us when they need it, and we want to plan for it before we need it.
Absolutely. Can't stress this enough. You don't ever want to be asking for capital when you need it. You want to have a plan in place and be executing that plan and that strategy long in advance.
Hmm.
So that also brings me to thinking a lot about revenue. So you and I both, say not all revenue is equal.
Hmm.
From a lender's view, how do financially minded CEOs think about growth differently?
So, a financially minded CEO isn't going to just say, is revenue growing? They're going to ask if it's profitable, predictable, and then repeatable. They're also going to look at operational efficiency. Essentially, can we maintain this long term? Because if we can't maintain this long term, it's going to lead to burnout for the CEO. You're going to have high turnover for your employees. And I don't know what the current figure is, but one of the figures I heard a couple years ago was that it typically takes 20 to 25,000 to train a new employee. So if you're not building operations that are actually going to be sustainable, you're just going to be continuing that chaos cycle.
I couldn't agree more. And as I think about that revenue, that repeatable part, whenever we think about that, not just from a lending perspective, but if I look at it from the CFO seat, it's how are you going to exit that business?
Mhm.
Because, the mindset of that CEO is really what drives the business forward. And we
Mhm.
need to make sure that that's in place in a way that they're leading the business, not just being reactive.
Mhm.
So when I think about mindset, What's the biggest mindset shift that you see when a founder starts to think like a financially minded CEO rather than just being a reactive business owner?
I love talking about mindset, and I love thinking of mindset from day one. This is just being an entrepreneur is it's a completely different animal, and I feel like mindset is one of the best things that you can invest in. So when we're thinking about being a financially minded CEO, we want to stop being reactive. We want to start being intentional. Stop asking, can we do this? Start asking, should we do this? Because growth isn't just the goal, sustainability and wealth are always going to be the goal. So start planning before committing. Always think at minimum 12 to 36 months in advance. Protect your liquidity and think about capital being a tool for leverage rather than the solution to your problem. And one of the things I always I like founders and CEOs to keep in mind is calm is profitable. We are looking for things that are calm, sustainable for the future.
Absolutely. I couldn't agree more. I think about being new in business and trying to figure all of this stuff out and having a full calendar and living in the chaos. It's not profitable and it's not sustainable long term. So, what
Hmm.
we're really trying to do is get to predictable and get entrepreneurs and founders to the life that they really want. So,
Hmm.
if a founder is listening and they realize that they've outgrown this guesswork and this chaos that we're talking about, what would you want them to understand before they start to raise capital or approach a lender like yourself for a loan?
So I'd like them to understand raising capital isn't the starting line, it's a milestone. Before you're raising capital, understand your numbers, your timing, your goals. Know why you're borrowing, what your plan is going to be to repay that, and what's your long term strategy. I really like to see founders and entrepreneurs have a deep understanding of their financials, the cash flow life cycle, and how they're going to continue sustainable growth. I really wish founders built lending relationships before they needed the funding. And then I would say lenders want to back CEOs who are going to be transparent, prepared, realistic, and consistent. I recently had somebody who was acquiring a building at maybe a 20th of the cost that it would have been to build that same building. They had really strong liquidity. They were just looking for a loan amount of maybe 30% of the total project cost. And so this just looked like a slam dunk deal. They did not disclose a bankruptcy from a year prior. And
Mm.
in their defense, the bankruptcy, like the whole thing was kind of it was bogus. It was one of those stories that you hear. There was nothing that, was equivalent to poor financial management. It was really just words, like it essentially was them
Like a
just not getting.
restructuring.
Yeah, yeah, they didn't get communication about a lawsuit that happened, and so they weren't aware of it. Essentially, the only option they had was to just declare bankruptcy. And so there was no reason whatsoever that they should have had to, but a lender is going to feel like transparency is being violated when they find out last minute. So it's good to be transparent, know your long-term goals, be realistic and consistent. Capital is always going to follow clarity.
I love that. And that's some great advice. If you could pick one thing that you wish founders did early on, what would be your top advice for them to start today if they haven't done it already?
So I always love investing in mindset and then have the scary conversations. To be vulnerable, going from W-2 to self-employed was really scary. And I remember being scared to walk into the bank and talked to the banker and opened up my account because I didn't have any income to prove, and I was in banking. I know that bankers open up accounts for startups all the time, but rather than be, scared and delaying it, I went in, talked to the banker. We had a really great conversation about my long-term growth. And so I was actually able to walk out of there day one with no income. And because of the growth plan that we talked about, I was able to establish business credit without ever showing a single penny of income. So have the scary conversations. Don't be afraid to ask for help. We're not going to be judging you. We genuinely want to help you succeed.
I love that. That is a great tip. That scary conversation, mm, well worth it. And I have
Mhm.
never had one of those that has gone as bad as I've made it in my mind.
Right?
It can be scary and a lot of times uncomfortable, but
Mhm.
do it anyway. So Jen,
Exactly.
today's conversation has been great. Before we wrap up, I'd love to know what's one secret that you wish you would have known starting out as an entrepreneur?
I think you really need to have your plans and your team in place. And by team, I mean essentially having a boardroom of advisors. So you want to have your attorney from day one. You want to have your CPA who's well versed in self employment income and ideally the industry that you're involved in. You want to have, a commercial lending broker or your bank lender, whatever lending looks like for you. You want to have them set up, start building that relationship. You want to have your bookkeeper set up, maybe your fractional CFO. So have that team that's essentially going to be your boardroom advisors set up from day one, because I guarantee you these people are going to want to help you see you grow.
Absolutely. And that's a really great point. Even if you're not ready for a full time engagement with a lot of these people, they
Mhm.
usually have an hourly rate that's worth a little bit of their time so that
Mhm.
you can get just some general guidance. So you're not flying blind and doing all of this alone.
Mhm.
So today's episode has been fantastic. Before we wrap up, if our listeners would like to reach out to you and hear more about what you're doing or talk about some of these lending options we've discussed, what's the best way for them to reach out to you?
So if they'll email us at info@wildfigcommerciallending.com, we can go ahead and send them our Calendly link and set up an appointment to discuss future options.
Thank you so much, Jen. And thank you to
Right.
everybody for listening to C Suite Secrets. If you have found today's conversation as valuable as I have, be sure to hit that like and follow button. And be sure to share this episode with somebody who's building a business. It can get lonely out there. If you want more tips on how to grow your business between episodes, you can join me on C Suite Insiders on Facebook or reach out on Instagram at Heather Parsons Official. We'd also love to talk to you a little bit more about OneRoom and see how we can add you to our boardroom. Until next time, keep growing and remember, you don't have to do this alone.